Imagine this. You're a freelance graphic designer, right? And you just swapped services with a copywriter friend. You got some killer website copy. They got a brand new logo. Nice deal. No cash changed hands.
Happens all the time.
Or maybe you're a skilled woodworker. You trade some custom shelves for help setting up your online shop from a tech-savvy neighbor. It feels simple, like just helping each other out, doesn't it?
Yeah, a straightforward swap.
But here's the thing, the real twist, and it's critical if you're running a side hustle or a small business here in the US. The IRS sees the value of those transactions as income. Plain simple.
Just like cash.
Exactly. Like you received cold, hard cash. So for anyone navigating freelancing side gigs or operating a small unincorporated business, wrapping your head around how to handle these non-traditional earnings and the expenses that come with them, well, it isn't just important. It's absolutely essential for staying compliant. You really want to avoid those nasty surprises come tax time.
That's such a common scenario, and it's often the first time people realize, oh, running a business involves more than just reporting cash. That value you receive, even if it's services or property, it has an economic reality. And the tax system, well, it's designed to account for that value.
Right.
So whether you're designing websites, painting houses, consulting, selling crafts online, how you report that activity for taxes is different from being a W-2 employee.
Mm-hmm.
Understanding those differences is, well, it's key.
And that's precisely what we're diving into today. Welcome to the deep dive. We're taking a really focused, in-depth look specifically at the tax treatment of bartering income, other kinds of non-traditional earnings you see a lot in the gig economy, and of course the associated expenses for American side hustlers and small business owners.
Yeah, and we know the official IRS stuff, the publications, can feel dense, maybe a bit intimidating.
Definitely. Our mission here is to cut through that complexity, pull out the essential, actionable insights you need to know, and, make it understandable.
That's right. We're drawing our insights directly from the source key bits, from IRS Publication 334, that's the big tax guide for small business, and Publication 525, which covers taxable and non-taxable income.
Authoritative stuff.
Absolutely. And we've also looked at, questions people are actually asking online, like on Reddit forums. These are real-world concerns, common points of confusion. People need clarity here.
Couldn't agree more. Our goal is to make this whole topic digestible, highlight the crucial takeaways you really can't afford to miss, and hopefully give you the confidence to handle your side hustle or small business income and expenses correctly. This tax season and, well, going forward. Okay, let's unpack this layer by layer. Maybe start with the basics, like who exactly is self-employed for tax purposes?
Good place to start. Foundational, really.
So before we get too deep into income and expenses, let's nail down how the IRS defines self-employed, because it might apply to you even if you don't think of yourself as a full-fledged business owner.
It's actually a really broad definition, and it's the starting point for understanding everything else we'll talk about. The core definition, straight from the sources, is pretty simple. You are considered self-employed if you carry on a trade or business as a sole proprietor or an independent contractor.
Okay, and I think the crucial part for a lot of listeners, maybe people with a regular W-2 job who also do some freelancing or consulting on the side, is that you absolutely do not have to be doing it full time.
Exactly. That's a major point. Having a part-time business, a side hustle, doing gig work, any project you do intending to make a profit alongside your regular job, that still counts as self-employment for that specific activity.
So you have two different ways your income is treated.
Precisely. The income from your W-2 job gets taxed with payroll taxes withheld by your employer. But the income and expenses from your self-employment activity, that's subject to income tax and self-employment tax, which we'll definitely get into later.
Okay, so what does the IRS actually mean by a trade or business? How do they draw the line between that and, say, just a hobby? Because that affects deductions, right?
Good question. And yes, it matters a lot for deductions. Generally, a trade or business is an activity carried on to make a profit. That's the key intent. The IRS looks at, well, all the facts and circumstances to decide if it's a business or a hobby.
Like what kind of facts?
They consider things like, do you carry on the activity in a business-like manner? Keep good records. Do you have the expertise needed? Do you actually expect to make a profit? And have you made profits in similar activities before? Are losses due to things outside your control, or are you just, not really trying? Do you make changes to try and improve profitability? The sources really emphasize that the facts and circumstances of your specific situation are what matter.
Okay, so if you're actively trying to make money, treating it seriously, keeping records, even if it's part-time, the IRS probably sees it as a trade or business. And if you're self-employed, sole proprietor, independent contractor, how do you report all this? The money in, money out.
Right. If you operate as a sole proprietor or an independent contractor, the main form you'll use is Schedule C, profit or loss from business.
Okay, Schedule C.
Yep. It gets filed as part of your personal income tax return, your Form 1040 or 1040-SR. Think of Schedule C as your business's income statement for the year. You report your gross business income there, then you subtract your eligible business expenses. That gives you your net profit or net loss.
And where does that number go?
That net profit or loss figure then flows onto Schedule 1 of the Form 1040, which is for additional income and adjustments. And from there, it hits your total income calculation on the main Form 1040.
Got it.
Oh, and the sources also mentioned something interesting. Certain statutory employees, these are people who get a W-2, but there's a check mark in box 13 for statutory employee. They also use Schedule C to report their income and expenses related to that specific work.
Huh. So even some W-2 folks might need Schedule C. Okay. What about spouses? Say a couple is working together on a side hustle, maybe an Etsy shop or something, not formally incorporated. How does that work?
That's another common situation the sources cover. If you and your spouse jointly own and operate an unincorporated business together and you share in the profits and losses, the IRS generally considers you to be in a partnership by default.
Even without a formal partnership agreement.
Yep. That's off of the default classification.
And partnerships file differently, don't they? More complex.
They do.
Yeah.
Partnerships typically file a separate informational return. That's Form 1065, U.S. Return of Partnership Income. The partnership itself doesn't pay income tax, but it reports everything. And then each partner gets a Schedule K-1.
K-1.
Right. Schedule K-1 shows that partners share the income, deductions, credits, etc. Then the partners report their K-1 info on their individual Form 1040s. So yeah, it involves filing that extra Form 1065, which adds complexity.
That does sound like a lot more paperwork, especially for just a small side business run by a couple. Is there a simpler way?
Yes, thankfully. There's a very useful option called a qualified joint venture, or QJV. The sources detail this pretty well. If you and your spouse are the only members of this jointly owned, unincorporated business, and you both materially participate.
Hold on, what does materially participate mean there?
Good clarification. It's similar to how it's used elsewhere in tax law. It basically means you're involved in running the business on a regular, continuous, and substantial basis. Think active involvement, not just occasional help or being a passive investor. For the QJV election, both spouses need to meet this test.
Okay, so both spouses actively working in the business, they file their personal taxes jointly. What's the benefit of electing QJV status?
The main benefit, especially for smaller spousal businesses, is you get to avoid filing that separate Form 1065 partnership return.
That's huge.
It is. Instead, each spouse reports their share of the business income and expenses on their own separate Schedule C form. Both Schedule Cs get filed with your joint Form 1040.
So 2 Schedule Cs instead of 1 Form 1065 and 2 K-1s.
Exactly. And then each spouse calculates their individual self-employment tax based on their own Schedule C profit, using separate Schedule SE forms.
Why is it important for each spouse to file their own Schedule C and SE under this QJV thing?
This is really crucial for Social Security and Medicare credits. By reporting their share of the income and paying SE tax individually, each spouse gets credit for those earnings under their own Social Security number.
So it builds their personal record for retirement.
Precisely. It builds up their eligibility and potential benefit amounts for future Social Security, retirement, disability, and survivor benefits, plus Medicare eligibility down the road. If they were a formal partnership filing a 1065, it works out eventually, but the QJV simplifies how it flows back to the individual records via the separate Schedule Cs and SEs, ensures both participating spouses get that credit directly.
That seems like a really valuable benefit, especially for long-term planning. Okay, so the core takeaway here is, if you're doing any activity for profit, even part-time, alone, or with a spouse, you're likely self-employed. And understanding Schedule C and maybe the QJV option for couples is step 1 for reporting it right.
Exactly. It really sets the stage for how you track and report all the income you earn and the expenses you incur in that business.
Okay, now let's get into the area that, based on what we see online, really seems to trip people up. Bartering income. We started with that scenario, trading services. The fundamental rule here is something every side hustler just has to internalize.
Yes, this is fundamental. The rule from the IRS publications is absolutely clear. When you barter, meaning you trade your services or property for other services or property, you must include the fair market value, FMV, of what you receive in your gross income.
Okay, let me just repeat that to be crystal clear. It's not the value of what you provided, it's the value of what you got back in the exchange. That's the income.
Exactly. That's the taxable event, the economic value you received in return for your business activity. And that value is measured by the fair market value at the time the exchange happens.
And how do they define fair market value, FMV?
The sources define it as the price that property or services would change hands between a willing buyer and a willing seller when neither person is forced to buy or sell, and both people have reasonable knowledge of the relevant facts. Basically, think, what's the going market rate for whatever it is you received?
Okay, determining FMV for, say, standard services might be straightforward. It's your usual rate or what that service normally costs. But what if it's less clear? Like you trade web design for, I don't know, a batch of unique artisanal soaps from a friend. How do you value that?
That's where it can get a little tricky in practice, yeah. The IRS guidance basically says you need to make a reasonable determination. If there isn't an established market price for the specific thing you received, you might look at comparable items or services.
So for the soaps.
For the artisanal soaps, you'd look at what similar quantities and quality of handmade soaps sell for online or in local shops. If it's a unique service you received, what do other providers typically charge for that kind of service? The key is making a reasonable, good faith effort to figure out the market value and documenting how you arrived at that value. That's part of good record keeping.
Let's look at those classic IRS examples they provide because they really make the rule concrete. First, the one with the self-employed accountant and the house painter.
Yeah, that's a perfect illustration. So the self-employed accountant does accounting work for the self-employed house painter's business. In return, the painter paints the accountant's home.
Oh.
Now, they might be members of Barter Club in the example, but the principle applies, even if it's just a direct trade.
Okay, so what's the tax consequence?
According to the IRS example, both the accountant and the house painter must include the fair market value of the services they received in their gross receipts. That income gets reported on their respective Schedule C forms.
So if the accounting work was worth, say, $2,000, and the house painting was also worth $2,000, the accountant reports $2,000 of bartering income on their Schedule C, and the house painter also reports $2,000 of bartering income on their Schedule C.
Precisely. From the IRS's perspective, it's as if they each received $2,000 in income and then used it to pay the other person. The economic value exchanged is the income. Even though no cash changed hands, they effectively paid with their services.
Wow, okay. What if the bartering happens through a third party, like one of those formal barter clubs that use credits or points?
The sources cover that specifically too. If you're part of a barter club that uses credit units or maybe barter dollars as the medium of exchange, the value of those credit units added to your account is considered income in the year they are credited to you.
Wait, income in the year they're credited, even if you don't actually spend those credits until, like, the next year?
Yes, that's another really crucial point. Your income isn't delayed just because you haven't redeemed the credits yet. The value is taxable as soon as those credits hit your account and are available for you to use.
So the moment you can use them, that's when it's income?
Basically, yes. From the IRS perspective, you have constructive receipt of that value when the credits are in your account and under your control. That's when the economic benefit is considered realized for tax purposes.
Okay, constructive receipt. How does the IRS even find out about these bartering deals? Do you get some kind of tax form?
Sometimes, yes. Formal barter exchanges, especially the organized clubs, are generally required to issue a Form 1099-B. That's proceeds from broker and barter exchange transactions. It reports the fair market value of goods or services members received through the exchange during the year.
1099-B. What about less formal bartering, just between two people?
For other, less structured bartering, it might potentially be reportable on Form 1099-MISC. Miscellaneous information, depending on the specifics, like if one party is clearly paying the other for services in the course of their trade or business.
But, and this seems absolutely critical for everyone listening, just like with cash income from your business, the sources make it explicitly clear. Bartering income is taxable whether or not you actually receive a 1099-B or a 1099-MISC for it.
Right, absolutely. Cannot stress that enough. The responsibility to figure out and report all your income rests squarely on you, the taxpayer. Just waiting to see if you get a 1099 form is a recipe for underreporting if you had income that wasn't formally reported to you.
So, connecting the dots here, why is the IRS so focused on these non-cash exchanges? What's the underlying principle?
Well, from the tax system's viewpoint, it's about capturing all economic activity and ensuring fairness. Think about it. The economic value you get in a barter deal is fundamentally the same as if you receive cash and then immediately turned around and used that cash to buy the other person's stuff or services.
Right.
If you earned $2,000 cash for your work and used it to pay a painter, that $2,000 cash is clearly income to you first. Bartering directly for $2,000 worth of painting is economically the same thing. That economic value is income, and income is taxable. That's the fundamental aha moment the sources try to drive home. Non-cash compensation isn't free money. It's income with a fair market value. Ignoring it is like ignoring cash income.
That definitely clarifies the core concept. You really have to think value received, not just money in the bank.
Exactly.
Okay, so beyond bartering, the publications highlight several other types of income that side hustlers, freelancers, and small business owners might run into. Things that also need to be reported on Schedule C, even if it's not a straightforward fee-for-service payment.
That's correct. The modern economy has, lots of ways people earn money outside traditional jobs. The sources are very clear. All income you receive from sharing economy activities or gig work, think driving platforms, delivery apps, freelance marketplaces, maybe short-term rentals, all of it must be included in your gross income.
And this is true even if you don't get a Form 1099-K from the platform, right? Because those have reporting thresholds.
Absolutely. The requirement to report your gross receipts from these activities is totally independent of whether you get a form or what the reporting threshold on that form is. If you earn the money or receive the value, it's taxable income. You report it on Schedule C, and yes, it's also subject to some employment tax, just like your other Schedule C income.
Okay. What about payments you might receive for lost income? Say your business activity gets interrupted because of a disaster or something.
Yes, that's specifically addressed. If you get payments from insurance or maybe other sources because your normal business activities were reduced or stopped, those payments generally must be reported as income on Schedule C.
Even if the business isn't active when you get the check.
Even then. The logic is that these payments are compensating you for business income you would have earned, so they're treated as business income.
And damages. Like if you win a settlement related to your business.
Generally, yes. Compensation for injuries connected with your business usually has to be included in gross income. And the sources explicitly state that punitive damages, those meant to punish wrongdoing, rather than just compensate for actual loss, must always be included in income. Doesn't matter if they relate to a physical injury or not.
What about kickbacks? Do you actually have to report those?
Yes, the guidance says kickbacks must be included in income on Schedule C. There is a little exception mentioned. You might be able to treat them as a reduction of a related expense or maybe a capital cost or cost of goods sold in some cases. But otherwise, yep, they're considered income from your business activity.
How about things like incentive payments, say, from a manufacturer to a salesperson who's self-employed?
If you get those kinds of payments as a salesperson, they're considered income. If you get them in the course of your self-employment, they go on Schedule C. If maybe you received an incentive but weren't self-employed in that specific role, say you got a manufacturer incentive unrelated to your main side gig, then it would typically be reported as other income on Schedule 1, Form 1040, line 8C.
Okay, this next one sounds a bit more complex. What if you get paid for your services with something like a promissory note or restricted property, like company stock that you can't sell right away? That's not cash or a direct trade.
Right. The sources cover this too, noting it's generally taxable income. If you receive a promissory note for your services, you usually have to report the face value or the issue price of the note as income when you receive it.
And restricted property, like stock with vesting rules.
For restricted property, like stock that has rules preventing you from selling it immediately, the fair market value of that property is typically included in your income when the restriction lifts. That's when it becomes substantially vested.
So when you actually gain full control or the right to sell it.
It's exactly. However, there's something called a Section 83B election. You can sometimes choose to include the value in your income in the year you receive the restricted property, even with the restrictions still in place. This can have different tax outcomes depending on whether you expect the property's value to go up or down significantly before it vests. Publication 525 has more detail on that.
It really sounds like the general rule is if you received value in almost any form in exchange for your business activities, the IRS likely considers it taxable income. Are there things that might seem like income but actually aren't considered taxable business income in this context?
Yes, the sources do draw that line. A key example is unrealized appreciation of property. Let's say you own a business asset like equipment or maybe some stock, and its value goes up on paper. You generally don't have taxable income until you actually realize that gain, usually through selling it or some other taxable event.
So just holding an asset that increases in value isn't income yet.
Correct. Another example is consignments. If you give merchandise to someone else to sell for you on consignment, you don't have income until the consignee actually sells it to a customer. The title and risk usually stay with you until the sale happens.
That distinction between appreciation and realization is important.
Absolutely. And the sources also mention specific things explicitly excluded from income, like certain qualified disaster relief grants meant to cover necessary expenses you incur. But they also clarify that unemployment assistance received under those same acts is generally taxable unemployment compensation, which gets reported separately.
Okay. One last unique item from the sources on income. Notary public fees. How are those handled?
Right, this is a specific one. Fees you receive for performing notary services are reported as income on Schedule C. However, the sources specifically highlight that these particular fees are not considered net earnings from self-employment, meaning they are not subject to self-employment tax. That's a very specific exception to the general rule that Schedule C income is subject to SE tax. An important detail for anyone doing notary work as part of their business.
Okay, so the big takeaway from this section is really be expansive when you think about business income. It's not just cash. It's the fair market value of bartered items, all your gig economy earnings, regardless of 1099s, lost income payments, certain damages, kickbacks, incentives, the value of notes or restricted property you got for your work. Being diligent in identifying and valuing all these income streams is really step one.
Exactly. You've got to cast a wide net when thinking about what makes up your business's gross receipts. It's essential for accurate reporting.
All right, so we've talked about all the different ways you might bring income in as a self-employed person. Now, for the flip side, which is often where you can significantly lower your tax bill, business expenses, and deductions, the good news is you can generally deduct the ordinary and necessary costs of running your trade or business.
Yes, and this is where that meticulous record-keeping we keep mentioning truly pays off, as we'll discuss more later. But first, let's make sure we understand what the IRS actually means by ordinary and necessary.
Right, it's not just everyday language, it's a specific tax definition.
Exactly. An expense is considered ordinary if it's common and accepted in your particular trade, business, or industry. It doesn't have to be something you pay frequently, but it needs to be customary or expected in your line of work.
Like?
Well, for a freelance writer, maybe the cost of grammar checking software would be ordinary. For a painter, the cost of brushes and paint is definitely ordinary.
Okay, common and accepted. And what makes an expense necessary?
An expense is necessary if it's helpful and appropriate for your trade or business. It doesn't have to be absolutely indispensable, like you couldn't possibly operate without it, or the only way to do something, but it has to be relevant and beneficial to your business operations.
So helpful and appropriate.
Right. That grammar software is helpful for the writer. The brushes and paint are appropriate for the painter.
Okay, so if a cost is typical for your field and it helps you run your business, it's likely deductible. Let's look at some key deductible expenses that come up a lot for side hustlers. Car and truck expenses, that's a big one, especially for people doing deliveries, driving for ride sharing, maybe traveling to client sites.
Definitely a big one. And you have a choice here when deducting vehicle expenses for your business. You can deduct the actual expenses of using your vehicle, or you can use the standard mileage rate.
Okay, two methods. What does deducting actual expenses involve?
Actual expenses means you track and claim the specific costs of operating your vehicle for business purposes. This includes things like gas, oil, repairs, tires, insurance premiums, vehicle registration fees, lease payments if you lease the car, and depreciation if you own it.
Lots to track there. What about the standard mileage rate?
The standard mileage rate is simpler. For 2024, it's 67 cents per business mile. The sources mention the 2025 rate is projected at 70 cents per mile. The IRS sets this rate each year, and it's meant to cover the average costs of gas, oil, maintenance, repairs, and depreciation, all bundled into one per mile figure.
Can I kind of mix and match, like use the standard rate but also deduct my gas receipts or insurance?
No, you have to pick one method for a specific vehicle in a given year. And there are rules about switching methods later, especially if you start with the standard rate. If you use the standard mileage rate, it's instead of deducting most of those actual operating costs, like gas, oil, maintenance, depreciation.
So it replaces those specific costs.
Right. However, regardless of which method you use, actual expenses or standard mileage rate, you can still separately deduct business-related tolls and parking fees. Those are deductible either way.
Good to know. Now, how do you figure out the deductible amount if you use your car for both business and personal trips? That seems like the common scenario for a side hustle vehicle.
It is, and this is absolutely crucial. It requires good records, like a mileage log. You have to divide all your vehicle expenses, if you're using the actual expense method, based on your business miles versus your personal miles.
Another example.
The sources give a clear one. Say you drove a van 20,000 total miles during the year. You meticulously logged 16,000 of those miles as specifically for business, maybe client visits, deliveries. The other 4,000 were personal use, which includes commuting from home to your main W-2 job. By the way, that's usually considered non-deductible personal mileage unless your home is your principal place of business for the side hustle.
Okay.
So in that case, you can only claim 80%, that's 16,000 business miles divided by 20,000 total miles of your actual operating costs, gas, repairs, insurance, depreciation, etc., as a business expense on Schedule C.
And if you use the standard mileage rate instead?
Then it's simpler math. You
Right.
just multiply your 16,000 business miles by the standard rate for that year, like 67 cents for 2024.
Makes perfect sense the deduction matches the business use percentage. The sources also mentioned depreciation limits if you own the vehicle and use the actual expense method.
Yes, there are annual limits on how much depreciation you can claim for passenger automobiles. That includes cars, light trucks, and vans used in your business. This includes any Section 179 expensing or special depreciation allowance you might take. These limits change each year. For instance, for vehicles placed in service in 2024, the total first-year depreciation limit is generally $12,400, or $20,400 if you claim the special depreciation allowance. There are exceptions for heavier trucks and vans that meet certain weight requirements. They might not be subject to these specific passenger vehicle limits. The detailed rules are in Publication 946, How to Depreciate Property.
Okay, so vehicle expenses need careful tracking of business versus personal use and potentially depreciation limits. Another major area, especially for home-based side hustlers, is the business use of your home, the home office deduction. This one definitely has a reputation for being tricky.
It absolutely is tricky, and it's subject to very specific, strict IRS tests. You have to meet these tests to qualify for any deduction. Basically, to deduct expenses for business use of your home, you must use a specific area of your home exclusively and regularly for your business.
Okay, let's break those down. What exactly does exclusive use mean?
Exclusive use means you use that specific area of your home only for your trade or business. No mixing business and personal use in that specific spot. The sources give a clear example. An attorney uses a den to write legal briefs, but the family also uses the den for watching TV or recreation. That den would not qualify because it's not used exclusively for business.
So just clearing off the dining room table sometimes to work wouldn't cut it.
Definitely not. It has to be a specific, identifiable space,
Right.
a room or part of a room used only for the business.
Are there any exceptions to that strict exclusive use rule?
Yes. The sources mention two key exceptions. The exclusive use test doesn't apply if you use part of your home for storing inventory or product samples for your business, as long as your home is the sole fixed location of that business. It also doesn't apply if you use part of your home as a daycare facility, provided you meet certain licensing or registration requirements. In those specific cases, you don't need exclusive use, but other rules still apply.
Okay, inventory storage and daycare. What about the regular use test?
Regular use means you use the area for your business on an ongoing, continuing basis. Just occasional or incidental use of a part of your home for business, even if it's exclusively for business on those few occasions, won't meet the regular use test. It has to be a consistent part of your business operations.
So specific area used only for business and used on a continuing basis. Are there other requirements too?
Yes. Beyond exclusive and regular use, the business part of your home must generally be your principal place of business for that specific trade or business. This is often the case for many home-based freelancers or side hustlers.
How do you figure out if your home is your principal place of business? Especially if you sometimes work at client sites or maybe a co-working space.
Determining the principal place of business involves looking at all the facts and circumstances. Generally, though, if you use your home office for the essential administrative or management activities of your business, think billing, record-keeping, scheduling appointments, and you have no other fixed location where you conduct substantial amounts of those admin activities, then your home office likely qualifies as your principal place of business.
Even if you perform the actual service elsewhere.
Even if you perform services or meet clients somewhere else, yes. If your home office is where the core administrative work gets done and there's no other fixed place for that, it can be your principal place. Alternatively, even if it's not your principal place, you might still qualify if you use the home office exclusively and regularly as a place where you physically meet or deal with patients, clients, or customers in the normal course of your business.
Okay, so meeting clients there counts.
Or a third way to qualify is if it's a separate structure not attached to your home, like a detached garage or a studio shed that's used exclusively and regularly for your business.
Wow, okay. That's a lot of detailed rules. Principal place, are meeting clients, or a separate structure, and all require exclusive and regular use, except for those inventory daycare situations. And I remember hearing there are limits on the deduction itself.
Yes, absolutely. The amount of the home office deduction you can claim is generally limited by the gross income generated by the business activity conducted in that home office, minus other business expenses unrelated to the home office. Basically, you can't use the home office deduction to create or increase a net loss from the business activity itself. Any disallowed amount can usually be carried forward to future years, though.
And how do you actually calculate the deductible expenses? Are there different ways?
Yes, there are two main ways. The standard method, sometimes called the actual expense method, or the simplified method.
Tell me about the standard actual expense method first.
Okay. Under the standard method, you figure out the actual business percentage of your home. Usually this is done by dividing the square footage of the area used exclusively for business by the total square footage of your home. Sometimes, if the rooms are roughly equal size, you might use a room count method.
Then apply that percentage.
Exactly. You apply that business percentage to your relevant indirect home expenses, things like a portion of your mortgage interest, if you own, real estate taxes, homeowners or renters insurance, utilities like electricity, gas, water, maybe general home repairs that benefit the whole house. You'd also deduct 100% of any direct expenses that benefit only the business space, like painting just that office room. And importantly, under this method, you can also claim depreciation on the business portion of your home itself if you own it.
Okay, that sounds comprehensive but requires tracking lots of home costs. What's the simplified method?
The simplified method is an alternative calculation designed to, well, simplify the record keeping. Instead of tracking and allocating all those actual home expenses, you can deduct a prescribed rate set by the IRS, multiplied by the allowable square footage of your qualified home office space.
What's the rate?
For recent years, including 2024, the rate is $5 per square foot, up to a maximum of 300 square feet of qualifying space. So the maximum simplified deduction is $1,500 per year. 5 cells T-foot, 300 square foot.
That sounds much easier. Any downsides?
While it's definitely simpler, it might result in a smaller deduction compared to calculating your actual expenses, especially if you live in a high-cost area or have a larger dedicated space. Also, a key difference is that you cannot claim depreciation on your home when using the simplified method. This could affect the calculation of gain if you eventually sell your home. But for many side hustlers, the simplicity is a major advantage.
Okay, so the home office deduction requires careful qualification based on use, and then a choice between detailed actual expense calculation or the simpler square footage method. Definitely something to look into if you work from home. Moving on, what about travel expenses? Specifically, business travel away from home.
Right. Deductible travel expenses are the ordinary and necessary costs you incur when you travel away from your tax home for your business.
What's a tax home? Is that where I live?
Not necessarily. Your tax home is generally the entire city or general area where your main place of business or work is located, regardless of where you actually maintain your family home.
Okay. And when are you considered away from home for tax purposes?
You're generally considered away from home if your business duties require you to be away from your tax home for a period that's substantially longer than an ordinary workday, and you need to sleep or rest to meet the demands of your work while you're away. This usually implies an overnight trip, or at least needing to stop for substantial rest during the trip to continue working effectively. Just driving across town and back in a day usually doesn't count as travel away from home.
Got it. So, if I qualify as traveling away from home for business, what kinds of costs can I deduct?
It covers a range of costs related to the trip. Things like your transportation costs to get to your business destination and back airfare, train tickets, bus fare. Also, fares for taxis, limos, or maybe commuter buses between the airport or station and your hotel, or between your hotel and your temporary worksite. The cost of shipping necessary baggage or business materials, your lodging costs while you're away, and meals.
Meals. Are business meals always fully deductible when you're traveling away from home? I feel like the rules on meals change sometimes.
You're right to be cautious. Generally, business meals incurred while traveling away from home are only 50% deductible. The sources specifically point out that the temporary rule allowing a 100% deduction for certain business meals provided by restaurants, that expired at the end of 2022. It wasn't extended into 2023 or 2024. So unless Congress changes something or a very specific exception applies, you should assume business meals, whether traveling or entertaining clients, are generally subject to the 50% limit.
Okay, 50% limit on meals is the general rule now. What if I drive my own car for this business travel away from home? How does that fit in?
Good question. The costs of operating and maintaining your vehicle for business travel away from home are part of your deductible travel expenses. You deduct these using either the actual expense method, tracking gas, oil, repairs, depreciation allocated to the trip miles, or by using the standard mileage rate for the business miles driven on that trip. Plus, just like with local driving, you can deduct any business-related tolls and parking fees separately, whichever method you use for the mileage itself.
And if I rent a car while I'm away?
If you rent a car while away on business, you can deduct the business use portion of that rental cost as a travel expense.
Okay, so travel away from home is really distinct from just the day-to-day local driving, which falls under general car expenses. Let's shift gears to something called bad debts. This sounds unpleasant and complicated.
It can be, yeah, but it's relevant if you extend credit to your clients or customers, meaning you let them pay you later. A business bad debt is basically a loss you suffer because a debt that was created or acquired in your trade or business becomes uncollectible. You might be able to deduct this loss as a business expense.
What are the requirements? I can't just decide someone's not going to pay and deduct it, right?
Right. Generally, for a debt that arose from selling your goods or services to be deductible as a business bad debt, you usually need to be using an accrual method of accounting.
Why?
Because under the accrual method, you would have already included the amount in your income when you earned it, even before getting paid. So if you never collect it, deducting the bad debt effectively cancels out the income you previously reported. Under the cash method, you generally don't report income until you actually receive payment. So if you never get paid, you never reported the income, meaning there's usually nothing to deduct as a bad debt. You also generally need to show you made reasonable efforts to actually collect the debt before you can declare it worthless.
Okay, so usually accrual basis and proof of collection efforts. What if I do something like guarantee a loan for a key client or maybe a supplier to help them out, and they default? Could that be a business bad debt for me if I have to pay?
Potentially, yes. The sources provide a specific example, actually, involving someone named Jane Zane who owns a dress company. If Jane guarantees a loan for a major client, Elegant Fashions, to help them stay in business, which helps Jane's business too, and then Elegant Fashions defaults, forcing Jane to pay the bank, that payment can potentially qualify as a business bad debt deduction for Jane.
But there are conditions.
Yes, several requirements must be met. The guarantee must have been made in the course of Jane's trade or business. She must have had a legal duty to pay the debt under the guarantee. The guarantee needs to have been made before the debt became worthless. And, importantly, she must have received reasonable consideration for making the guarantee, meaning it was done for a genuine business purpose related to her own business, not just as a personal favor.
Okay, very specific conditions for loan guarantees. What's the difference between a debt being totally worthless versus partly worthless?
Good distinction. If a business debt becomes totally worthless during the tax year, meaning there's no reasonable expectation of recovering any part of it, you can generally deduct the entire remaining amount owed in that year. If a business debt is only partly worthless, meaning you might still recover some but not all of it, you can sometimes deduct the worthless part. However, deducting partly worthless debts is generally only allowed if you use an accrual method of accounting and you actually charge off that partly worthless amount on your business books during the year.
Insurance premiums seem like they should be a more straightforward deduction. Is that generally true?
Generally, yes. Premiums you pay for various types of insurance directly related to your business are usually deductible as ordinary and necessary expenses.
Like what kinds of insurance?
This includes premiums for things like fire, theft, flood, or similar casualty insurance covering your business assets. Credit insurance that protects you against business bad debts. Group hospitalization and medical insurance premiums you pay for your employees. Not usually yourself, though there's a separate deduction for self-employed health insurance. Liability insurance. Malpractice insurance. Business interruption insurance, which covers lost profits if your business has to shut down temporarily. And of course, premiums for business vehicle insurance if you're using the actual expense method for your car.
Are there any types of insurance premiums that are generally not deductible as business expenses?
Yes, a couple of key ones. Premiums you pay for a policy that compensates you for your own lost earnings due to sickness or disability are generally not deductible as a business expense on Schedule C. Also, premiums paid for life insurance covering yourself, an employee, or anyone with a financial interest in your business are not deductible if you are directly or indirectly a beneficiary of that policy.
What does indirectly a beneficiary mean there?
The sources explain that if the policy owner, maybe the employee, is obligated to use the policy proceeds to repay a loan from you, then you're considered an indirect beneficiary, and the premiums wouldn't be deductible by you.
Okay, that makes sense. How about interest expense if I borrow money from my business?
Yes, interest paid on money borrowed specifically for business purposes is generally a deductible business expense. However, just like with car expenses, if a loan is used for both business and personal purposes, you have to allocate the interest based on how the loan proceeds were actually used.
Got an example for that.
Sure. The sources use a car loan example again. Say you took out a loan to buy a car, and you track your mileage and find you used the car 60% for business and 40% for personal trips during the year. If you paid $600 in interest on that loan during the year, you can deduct $360, that's 60% of the $600, as a business interest expense on your Schedule C. The remaining $240 is considered personal interest, which is generally not deductible.
Allocation is key again. Now, the sources also mention something called the de minimis safe harbor election for tangible property. That sounds technical, but maybe useful.
It is technical, but it's actually a really helpful practical rule designed to simplify things, especially for smaller purchases. It basically lets you choose to immediately deduct the cost of certain tangible property you buy for your business instead of having to capitalize it, treat it as an asset, and then depreciate it over several years.
What kind of property and what are the limits?
It applies to tangible property, like small equipment, tools, maybe furniture, computers, things like that. There are dollar limits. If your business has what's called an applicable financial statement, or AFS, which usually means you have audited financial statements prepared according to certain standards, you can elect to deduct amounts paid for tangible property up to $5,000 per item or per invoice.
And if you don't have those audited financial statements, which is probably most side hustlers.
Right. If you do not have an AFS, the limit is lower but still useful. It's $2,500 per item or per invoice. To use this safe harbor election, you also need to have a policy where you treat these small dollar items as expenses on your own financial accounting books for the year, even if your books are simple. It's a great way to avoid tracking depreciation for lots of small purchases.
That does sound very practical. Saves a lot of hassle on depreciation for smaller stuff. What other general business deductions might come up that we haven't hit?
Well, there are many other standard business costs that could fall under ordinary and necessary expenses, depending on your specific business. Think about things like legal and professional fees, including fees you pay someone to prepare the business part of your tax return. Rent you pay for business property, like an office or workshop, or the qualifying portion of your home if you take the home office deduction. Utilities for your business space, or the business portion. Supplies used in your business operations. Advertising and marketing costs. Business-related education or training that maintains or improves skills needed in your existing business. The list goes on. But it has to be directly related to carrying on your trade or business.
Okay. So while bringing in the income is obviously the goal, diligently identifying, carefully documenting, and then correctly deducting all your ordinary and necessary business expenses is absolutely vital. It's how you arrive at your true net business profit, and it significantly impacts your income tax liability.
Absolutely. And again, it all hinges on having good records to back up every single deduction you take. We can't emphasize that enough.
All right, so we've covered taxable business income in all its forms and the expenses you can deduct on Schedule C to get to your net profit or loss. But for self-employed folks, there's often another big tax they need to account for. Self-employment tax, SE tax.
This is a critical piece, and yeah, it often surprises new side hustlers or freelancers. SE tax is how self-employed individuals pay into the Social Security and Medicare systems. If you work for an employer, you see FICA taxes that Social Security and Medicare withheld from your paycheck, right? And your employer pays a matching amount.
Right.
Well, when you're self-employed, you're essentially wearing both hats. You're the employee and the employer. So you end up paying the equivalent of both halves of those taxes through the self-employment tax.
Okay, so it's like paying both the employee's share and the employer's share. Who actually has to pay this SE tax?
Generally speaking, you must pay self-employment tax and file Schedule SE which is attached to your Form 1040, if your net earnings from self-employment are $400 or more for the year.
Wow, $400. That's a really low threshold. So even a fairly small profit from a side gig can trigger the need to file Schedule SE and pay this tax. What's the rate?
For 2024, the total self-employment tax rate applied to your net earnings is 15.3%.
15.3%. How is that broken down?
It's made up of two parts. 12.4% goes towards Social Security, and the remaining 2.9% goes towards Medicare.
Okay, 12.4 plus 2.9 equals 15.3. Is that 15.3% applied directly to my net profit figure from Schedule C?
Not quite to the entire net profit. There's a small adjustment first. You actually calculate the SE tax on Schedule SE, and it's generally based on 92.35% of your net earnings from self-employment, your Schedule C profit.
And 92.35%. Why that specific number?
That 92.35% factor is a statutory adjustment. It effectively accounts for the fact that employees don't pay FICA tax on the employer's half of the FICA taxes. Since you, as a self-employed person, are paying both halves via SE tax, this adjustment lowers the base amount slightly to put you on more equal footing. It also relates to the fact that you get to deduct one half of your SE tax when calculating your adjusted gross income for income tax purposes.
Ah, okay. That deduction of half the SE tax for income tax is key. Can you walk through a quick example of how that calculation flows?
Sure. Let's keep it simple. Say your net profit on Schedule C from your side hustle is $10,000. First, you multiply that by 92.35% to find the base for SE tax. $10,000 times 0.9235 equals $9,235.
Okay, $9,235.
Then you apply the SE tax rate of 15.3% to that amount. $9,235.3 equals $1,413.86. That's your total self-employment tax liability.
$1,413.86.
Ouch. Yeah, it adds up. But then for your income tax calculation on Form 1040, you get to deduct one half of that SE tax amount. So $4,413.86 divided by 2 equals $706.93. You claim this deduction on Schedule 1, Form 1040.
So the SE tax itself is $1,413.86, but your income subject to regular income tax is effectively reduced by $706.93 because of that deduction.
Exactly. It helps offset the burden slightly on the income tax side. So you have two taxes calculated, the SE tax on $9,235, and then income tax on your $10,000 profit minus the $706.93 SE tax deduction and any other deductions.
Okay, that flow makes more sense. It's two separate but related calculations. Now, you mentioned the SE tax has a 12.4% Social Security part and a 2.9% Medicare part. Is there a limit on how much of your earnings is subject to the Social Security part, like with W-2 wages?
Yes, there is a limit, and it works similarly to the limit for employees. For 2024, only the first $168,600 of your combined earnings, that includes your W-2 wages if you have a job, plus your net earnings from self-employment after the 92.35% adjustment, is subject to that 12.4% Social Security tax portion.
So if my combined wages and net SE earnings go over $168,600 in 2024, the amount above that isn't hit with the 12.4% Social Security tax.
Correct. Any combined earnings above that threshold are not subject to the 12.4% Social Security tax. However, and this is important, the 2.9% Medicare portion of the SE tax applies to all of your net earnings from self-employment. There's no upper limit or wage base for the Medicare part.
No limit on the Medicare part. Got it. Is there ever an additional Medicare tax on top of that 2.9%?
Yes, the sources do mention that. If your total earnings, again, combined wages and SE earnings, exceed certain thresholds based on your filing status, for example, $200,000 for single filers, $250,000 for married filing jointly in recent years, you might be subject to an additional Medicare tax of 0.9% on the earnings that exceed that threshold. This is calculated separately.
Okay, something to be aware of for higher earners. Now, going back to income tax for a second earlier, you mentioned that notary public fees are reported on Schedule C but are not subject to SE tax. Can you just reiterate that point clearly?
Yes, absolutely. That's a specific statutory exception worth remembering. While the fees you earn for performing notary services are business income reported on Schedule C, the sources explicitly state they are not considered net earnings from self-employment. Therefore, those specific notary fees are exempt from the 15.3% SE tax. It's a unique carve-out.
Okay, good clarification. Now, the publications also talk about optional methods for figuring self-employment tax. That sounds like it could add complexity, but maybe also offer some opportunity.
This could be both, yeah. The optional methods, like the main one called the non-farm optional method, are basically alternative ways to calculate your net earnings from self-employment, specifically for SE tax purposes. They're particularly relevant in situations where your actual net earnings from the business are very low, or maybe even a loss.
Why would someone want to use an optional method if their profit is low or they have a loss? Wouldn't that just mean they owe little or no SE tax anyway?
That's the crux of it. These methods primarily exist for specific situations. For instance, maybe you had a low-income year, but you still want to get credit for Social Security and Medicare coverage for that year to build towards future benefits. Or perhaps you need to show a certain minimum level of earned income to qualify for certain tax credits, like the Earned Income Tax Credit, EITC, or the refundable part of the child tax credit. Using an optional method might allow you to report some positive net earnings for SE tax, even if your actual profit was lower or zero.
So wait, using an optional method could potentially mean you end up paying more SC tax than you would have based on your actual low profit or loss.
Exactly. That's a key point the sources make clear. Using an optional method can increase your SE tax liability in some cases. You'd be choosing to do it specifically to generate those creditable earnings for Social Security, Medicare, or to meet earned income requirements for other tax benefits like EITC or CTC.
Interesting trade-off. How do you know if you're even eligible to use an optional method, or when you must use the regular calculation based on actual profit?
The rules vary a bit depending on farm versus non-farm income, but for most side hustlers with non-farm income, the non-farm optional method rules apply. For 2024, you generally can use the non-farm optional method only if your gross non-farm income was $10,380 or less for the year. Or you might be eligible if your net non-farm profit was less than $7,493 and that net profit was also less than 72.189% of your gross non-farm income. It's a bit complex.
Okay, so eligibility is tied to gross income and the relationship between net profit and gross income.
Yeah.
When must you use the regular method?
If your net profit from non-farm self-employment is $7,493 or more for 2024, you must use the regular method, the 92.35% calculation, to figure your SE tax. You don't have the option then. But if your net profit is below that, or you have a net loss and you meet the gross income test, $10,380 or less, you can choose to use the optional method. If you use it with a loss or very low profit, it allows you to report a deemed amount of earnings for SE tax purposes, calculated based on a formula involving your gross income, generally 2/3 of gross, up to a limit, which is $6,920 for 2024.
That is definitely specific. It really sounds like something you'd need to carefully evaluate. Check your eligibility based on gross and net figures, and then maybe calculate your SE tax both ways, regular method versus optional method, to see which outcome is better for your overall tax situation, considering credits and Social Security goals.
Precisely. The publications and Schedule SE instructions guide you through figuring out eligibility and making the calculation if it applies. It's not something most people use every year, but it's crucial to be aware of if you have a very low income year or a loss. And getting those SE credits or qualifying for EITC, CCTC is important to you.
Okay, so SC tax.
Yeah.
It's a significant cost of being self-employed, covers those vital retirement and healthcare programs. It's calculated differently than income tax using that 92.35% base. Has limits for the Social Security part, but not Medicare. Might involve an extra 0.9% Medicare tax for higher earners. Has that notary exception, and even includes these optional methods for certain low-income situations.
It's definitely another layer of complexity that side hustlers need to fully understand and, importantly, plan for, particularly when it comes to making estimated tax payments throughout the year.
Right. With all these income sources to track, all the expenses to document, the SE tax calculation on top of income tax, it seems crystal clear that actually filing your tax return accurately and, more fundamentally, maintaining excellent records all year long are just absolutely non-negotiable for side hustlers.
Paramount, yes. The IRS sources hammer this point home again and again. Good records are your foundation. You need them to accurately report all your income cash, checks, credit cards, bartering value, gig payments, everything. And maybe even more critically, you need records to substantiate every single deduction you claim.
Why is substantiation so important?
Because if the IRS ever audits your return or even just sends a notice questioning something, the burden of proof is on you to show that every deduction you took was legitimate and calculated correctly. You need receipts, invoices, canceled checks, mileage logs, documentation for home office expenses, travel records. Without proper records, you could easily lose valuable deductions you were genuinely entitled to, simply because you can't prove them.
Okay, so record keeping is king. Let's quickly summarize the main forms a typical self-employed individual will likely need when they file their federal return.
Sure. The main return is Form 1040 or 1040-SR. Attached to that, as we discussed, you'll need Schedule C, profit or loss from business, to report your business income and expenses. If you run more than one distinct business, say freelance writing and an unrelated Etsy shop, you'll need to file a separate Schedule C for each one.
Okay, one Schedule C per business, then what?
The net profit or loss from your Schedule C, or the total from multiple Schedule Cs, gets transferred over to Schedule 1 of Form 1040, which is titled Additional Income and Adjustments to Income. From Schedule 1, that business profit or loss flows into the calculation of your total income on the main Form 1040. And if your total net earnings from self-employment from all your Schedule Cs combined are $400 or more, you also need to complete and file Schedule SE, self-employment tax, to calculate that SE tax liability we just talked about.
So Schedule C figures out the profit loss for income tax, and Schedule SE uses that figure to calculate the SE tax.
Precisely. The information flows from C to SE for SE tax, and from C to Schedule 1, and then 1040 for income tax.
You mentioned the $400 net earnings threshold for paying SE tax. Is that also generally the threshold that triggers needing to file an income tax return at all if self-employment is your only source of income?
Generally, yes. The sources state that for 2024, you must file an income tax return, Form 1040, if your net earnings from self-employment were $400 or more. Even if your net earnings are less than $400, you might still have to file if you meet any of the other standard filing requirements based on your total gross income, your filing status, and your age. Those rules are, in the main, Form 1040 instructions.
Okay, let's touch briefly on accounting methods again. The sources mentioned cash and accrual.
Right. Those are the two main overall accounting methods for tax purposes. You can also use special methods for certain specific items, or even a combination of methods sometimes, as long as the combination clearly reflects your income.
What's the practical difference for a typical side hustler between cash and accrual?
Under the cash method, which is definitely the most common for small businesses and individuals, you generally report income in the tax year you actually or constructively receive it, basically, when the money hits your hand or your bank account or is made available to you. And you generally deduct expenses in the tax year you actually pay them. Under the accrual method, it's different. You generally report income in the tax year you earn it. That means when all the events have happened that fix your right to receive the income, and you can figure out the amount with reasonable accuracy, even if you haven't actually received the payment yet. And you generally deduct expenses in the tax year you incur them, meaning when the liability is established, the amount is known, and economic performance has occurred, even if you haven't paid the bill yet.
Which method should someone choose?
Well, you have to choose an accounting method that clearly shows your income and expenses for your business, and then you need to use it consistently from year to year. Most individual side hustlers find the cash method much simpler because it aligns better with their actual cash flow. However, there's a big exception. If your business involves inventory, meaning you buy or produce goods to sell, the rules generally require you to use an accrual method, at least for figuring your cost of goods sold related to that inventory.
Can I use, say, the cash method for my consulting side hustle, but accrual for my personal investments, or different methods for two separate side hustles?
Yes. The sources say you can account for business items under one method, like cash for your consulting gig, and your personal items, like interest income reported by your bank, under another method, which is usually cash for individuals anyway. Also, if you have two or more separate and distinct trades or businesses, you can use a different accounting method for each one, but you have to maintain complete and separate books and records for each business.
What if I start out using the cash method, but later on maybe my business grows and I want to switch to the accrual method? Can I just do that?
Generally, no, not without permission. You usually must get IRS approval before changing your overall accounting method for your business. This typically involves filing Form 3115, application for change in accounting method. There are specific procedures. Some changes might qualify for automatic approval, others require advance consent from the IRS and might involve paying a user fee.
Okay, so changing methods isn't trivial. How about the tax year? Most individuals use the calendar year ending December 31st. Can a business use something different?
Most individual sole proprietors and QJVs use the calendar year because it matches their personal tax year, which makes filing much simpler. However, a business can potentially adopt a fiscal year that's any 12 consecutive months ending on the last day of any month except December, or even a 52-53-week tax year in some cases. But you have to keep your business books and records based on that chosen year.
And I assume changing your tax year also requires IRS approval.
Yes, generally it does. You typically need to file Form 1128, application to adopt, change or retain a tax year, to request IRS approval for a change, although again, certain situations might allow for automatic approval without filing Form 1128.
Okay. Now, given that income from a side hustle usually doesn't have taxes withheld like W-2 wages do, will most self-employed people need to worry about paying estimated taxes during the year?
It's highly likely, yes.
Yeah.
The U.S. tax system is pay-as-you-go. If you expect to owe at least $1,000 in tax for the year from your self-employment income, and any other income not subject to enough withholding, you're generally required to pay that tax throughout the year via estimated tax payments.
How does that work?
These payments are typically made in 4 installments, roughly quarterly, throughout the year using Form 1040-ES, estimated tax for individuals. You estimate your total expected income, deductions, and credits for the year, calculate the tax you expect to owe, including both income tax and SE tax, and then divide that amount by 4 to make the payments. Failing to pay enough tax during the year through withholding or estimated taxes can result in penalties when you file your return.
Okay. Estimated taxes are crucial to avoid penalties. Shifting gears slightly, what about payments you make to others as part of your business? Do side hustlers have responsibilities for issuing tax forms to people they pay, like contractors?
Yes, absolutely. This is a really important obligation for small businesses and side hustlers who hire independent contractors. If, in the course of your trade or business, you pay an independent contractor, that could be an individual, a partnership, maybe an LLC, treated as a partnership, $600 or more for services performed for your business during the calendar year, you are generally required to report those payments.
How do I report them?
You do this by issuing the contractor a Form 1099 NEC, which stands for non-employee compensation. And you also have to file a copy of that Form 1099 NEC with the IRS, usually accompanied by a summary form called Form 1096 Annual Summary and Transmittal of U.S. Information Returns.
When are those 1099 NECs due?
The deadline is usually quite early. You typically need to furnish the Form 1099 NEC to the contractor and file it with the IRS by January 31st of the year, following the year you made the payments. So payments made in 2024 would need a 1099 NEC issued by January 31st, 2025.
That's a tight deadline right after year end. How do I get the information I need to fill out the 1099 NEC, like the contractor's taxpayer ID number, their SSN or EIN?
Good question. Best practice is to request the independent contractor's taxpayer identification number by having them complete and sign a Form W-9, request for taxpayer identification number and certification, before you even make the first payment to them. Keep that W-9 on file. The sources really stress the importance of getting a completed W-9 from every contractor you expect to pay $600 or more, so you can fulfill your information reporting duties accurately and on time. You know, all these requirements we've discussed correctly: reporting all your income, claiming and substantiating deductions, calculating SE tax, figuring estimated taxes, issuing 1099s if you pay contractors, they all circle right back to that fundamental need for excellent record keeping. The sources are just relentless on this point.
It really seems like the linchpin for everything.
It absolutely is. You need records to track every penny of income, cash, checks, bartering value, platform payments, everything. You need records to back up every single deduction you claim: receipts, invoices, bank statements showing the expense, mileage logs, home office measurements and expense allocations, travel itineraries, and receipts. Keeping a separate business bank account is highly, highly recommended. It makes tracking business versus personal finances so much cleaner and easier. Good records don't just help you fill out the tax forms correctly, they're literally your defense if the IRS ever asks questions.
And finally, just briefly, what happens from a tax perspective if a side hustle doesn't work out, or maybe someone decides to just stop doing it, they go out of business?
The sources mention this briefly. If you cease your business operations, you'll need to file a final Schedule C, and, if applicable, a final Schedule SE for that business in the year it closes. If you sell off business assets, like equipment or property you used in the business, you might need to report those sales on Form 4797, Sales of Business Property, to figure any gain or loss. And if you sell the entire business as a going concern, you and the buyer might need to file Form 8594, Asset Acquisition Statement, to agree on how the sales price is allocated among the various business assets being transferred.
Okay. So from the very beginning, that first dollar earned or first service bartered, all the way through potentially closing down the business, diligent record keeping and understanding these forms and filing requirements are truly the non-negotiable pillars of being self-employed.
Absolutely. They are the difference between having a smooth tax filing experience and potentially facing penalties, lost deductions, and a lot of stress.
Okay, we have covered a ton of ground today. From defining who's self-employed and understanding taxable income goes way beyond just cash, to digging into deductible expenses, the complexities of SE tax, and those essential filing and record-keeping rules. It's really clear that navigating taxes as a side hustler or small business owner requires real attention to detail and proactive effort.
It certainly does. The tax landscape for the self-employed is definitely more involved than it is for traditional W-2 employees. But, the goal here isn't to overwhelm anyone. It's really to empower you with the knowledge you need to handle it correctly. And importantly, you don't have to figure it all out completely on your own.
That's a really key point. Where can someone turn if they need help or maybe more detailed information, drawing from the IRS sources we've been looking at?
Well, the primary resource is always going to be irs.gov. The official publications we mentioned, like Pub 334, Tax Guide for Small Business, and Pub 525, Taxable and Non-Taxable Income, they're all available there for free download. Plus, all the forms we talked about, 1040, Schedule C, Schedule SE, 1040 ES for estimated tax, 1099 AC, W-9, and their detailed instructions are right there too. The IRS website is constantly updated, and it really is the definitive source for the current rules.
And they have tools on the website too, right? To help answer questions.
Yes, they do. irs.gov offers tools like the Interactive Tax Assistant, or ITA. It's a pretty helpful online tool that can walk you through questions and answers for many common tax law topics based on your specific situation. They also have something called the IRS Document Upload Tool, DUT. This lets you respond digitally to certain IRS notices or requests for information by securely uploading documents online, which can save you postage and often gets you confirmation faster.
What if someone's having a specific problem with the IRS, like they're stuck in a dispute or something they can't seem to resolve through the normal channels?
For those situations, the Taxpayer Advocate Service, or TAS, is highlighted in the publications as a really valuable resource. TAS is an independent organization within the IRS. Their whole job is to help taxpayers resolve problems they haven't been able to fix through normal IRS channels and to protect taxpayer rights. They're described as your voice at the IRS.
That's good to know about. Are there options for free tax preparation help for people who might qualify?
Yes, definitely. The source mentioned two main programs. There's the Volunteer Income Tax Assistance Program, VIAS. VIA sites offer free basic tax return preparation, generally for people who make $64,000 or less. That threshold might change slightly year to year, persons with disabilities, and taxpayers with limited English proficiency. Then there's also the Tax Counseling for the Elderly program, TCE. TTE provides free tax help specifically targeted to taxpayers who are 60 years of age and older, often focusing on questions about pensions and retirement-related issues.
Great resources for those eligible, and for folks who need or just prefer to pay for professional help.
Of course, seeking help from a qualified tax professional is always an option and often a very good idea, especially if your situation is complex or you're just starting out with self-employment. That includes professionals like certified public accountants, CPAs, enrolled agents, EAs, who are federally licensed tax practitioners or tax attorneys.
Finally, the Small Business Administration, the SBA, is listed as a resource. How do they fit into the tax picture?
Well, the SBA itself and its direct partners typically don't provide tax preparation services. However, resources often associated with the SBA, like the Small Business Development Centers, SBDCs, and SCORE, which uses volunteer retired executives, offer free or low-cost business counseling and training. This counseling frequently includes guidance on fundamental business requirements, and understanding basic tax compliance and planning is usually part of that overall business management advice.
Okay, so bottom line. While the rules definitely require diligence, there's a pretty robust support system out there, from the IRS's own website and tools to volunteer programs, professional advisors, and even general business counseling resources. You don't have to feel like you're navigating all these complex rules completely alone.
Exactly. Using these resources can save you time, reduce stress, and help you avoid potential penalties. It ensures you're staying compliant while also taking advantage of every deduction and credit you're legitimately entitled to.
So, pulling this all together, what does this whole deep dive really mean for you, the listener, the person out there juggling a side hustle, freelancing, maybe running a small business?
I think it means recognizing that whether you're earning cash, trading services through bartering, getting paid via gig platforms, that economic value you receive is generally taxable income, usually based on its fair market value. It means you have the really significant benefit of being able to deduct the ordinary and necessary business expenses you incur to generate that income. And is a big sell. But the absolutely critical requirement is having diligent, organized records to support every single one of those deductions.
Right.
And it means you absolutely need to factor in self-employment tax on your net business earnings. That's your contribution to Social Security and Medicare, and it's in addition to your regular federal income tax.
Yeah, I think the most important lesson, really, from immersing ourselves in these official IRS sources is the absolute necessity of treating your side hustle or small business finances with the same level of seriousness and organization that you would apply to a traditional job's finances. Income needs meticulous tracking, expenses need solid documentation, and the required forms need to be filed accurately and on time.
Absolutely. A proactive, organized approach based on understanding these rules is truly the best way to avoid unpleasant surprises down the road. Like you said earlier, surprises are great for birthdays, not so much for tax day.
Indeed. Couldn't agree more. And, as we wrap up this exploration, it leaves me with a final thought, looking ahead a bit. As the way we all work continues to evolve so rapidly, more freelancing, more remote work, more bartering, just more diverse activities, making up this huge gig economy, effectively turning more people into small business owners, either by choice or necessity, how might our tax systems need to adapt? How can reporting and compliance be made simpler, more intuitive, maybe less burdensome for this growing segment of the workforce, while still ensuring everyone pays their fair share?
That's a huge question.
And relatedly, what responsibilities do the platforms in the online communities that facilitate so much of this modern work have in actively helping their participants understand and meet their tax obligations?
Those are really significant questions. Questions that policymakers and society as a whole will undoubtedly need to grapple with as the very definition of work continues to shift under our feet.
Definitely something to keep thinking about. Well, that wraps up our deep dive into the U.S. tax treatment of bartering and side hustle income, guided by the IRS's own publications. Thanks so much for joining us for this in-depth exploration.
And until next time, stay curious and stay informed.